Currency swap agreements have become an essential tool for China in its efforts to internationalize the renminbi, RMB, and reduce the global reliance on the US dollar. These agreements enable central banks to exchange their respective currencies directly, facilitating trade and investment without depending on the US dollar as an intermediary. By encouraging the use of the RMB, China aims to diminish the dollar's dominance in global markets, a move that represents a challenge to the status of the US dollar in international finance. China has been aggressively expanding its currency swap network, including the recent renewal of a $2 billion arrangement with Nigeria. This renewal reflects China's goal of enhancing trade and investment between the two countries while reducing reliance on the US dollar. The move comes on the heels of warnings from the US president-elect, who cautioned BRICS nations against adopting alternatives to the dollar, threatening significant repercussions for countries pursuing such a shift. Nevertheless, China continues to push forward in reducing the global financial system's dependence on the US dollar, signaling a commitment to developing an alternative international financial structure. As of February 2024, China has established over 40 currency swap agreements with countries worldwide, valued at approximately $586 billion, with 31 of these arrangements still active. Some of the key agreements include Saudi Arabia. In 2024, China and Saudi Arabia signed a significant $7 billion, 50 billion yuan, currency swap deal. This agreement is a part of Saudi Arabia's Vision 2030 initiative, which aims to diversify its economy and reduce dependence on oil revenues. The agreement facilitates RMB-denominated oil sales, marking a potential shift in global energy trade away from the US dollar. Russia. Following Western sanctions on Russia, China and Russia established a 150 billion yuan, $21 billion, currency swap deal to enhance trade and investment. By December 2023, over 90% of their bilateral trade was conducted in their local currencies, significantly reducing reliance on the dollar. Argentina. In June 2024, China and Argentina expanded their existing currency swap agreement to $18 billion over 3 years. This arrangement has been crucial for Argentina's economic stability during periods of crisis, allowing it to use RMB reserves and reduce its dependence on the US dollar for trade. South Korea. China and South Korea have a 360 billion yuan, $49.4 billion, currency swap agreement, which strengthens financial ties, reduces transaction costs, and provides a buffer against fluctuations in the US dollar. This also establishes South Korea as an RMB financial hub in Asia. European Union. The European Central Bank and China's People's Bank of China, PBOC, have a currency swap agreement valued at 350 billion yuan, $48 billion, boosting RMB liquidity in Europe and promoting trade and investment between China and European Union member states. Brazil. In March 2023, China and Brazil entered into an agreement to conduct trade in their respective currencies, bypassing the US dollar. This move promotes RMB usage in agricultural trade, lowering currency exchange costs and increasing efficiency. United Arab Emirates, UAE, a 35 billion yuan, $4.8 billion, currency swap agreement between China and the UAE facilitates oil transactions in RMB, aligning with the UAE's economic diversification goals and reducing reliance on the dollar in the energy sector. Nigeria. China and Nigeria's 15 billion yuan, $2 billion, arrangement, initially signed in 2018 and renewed in 2021, helps both countries conduct trade in their local currencies, easing foreign exchange pressures and reducing dependence on the US dollar. Pakistan. China and Pakistan have a 20 billion yuan, $2.7 billion, currency swap agreement, supporting trade under the China-Pakistan Economic Corridor, CPEC, and boosting Pakistan's foreign reserves. Hong Kong. The PBOC and the Hong Kong Monetary Authority have a currency swap arrangement worth 400 billion yuan, $54.9 billion, solidifying Hong Kong's role as a financial gateway for RMB internationalization. These currency swap agreements serve as strategic tools for China to promote the RMB, reduce reliance on the dollar, and strengthen economic ties with key global partners. By reducing dependence on the US dollar, China and its partners aim to foster greater financial stability and economic resilience. The growing network of currency swaps between China and other countries poses a challenge to the US dollar's status as the global reserve currency. As the demand for the US dollar declines, its value weakens, which in turn limits the United States' ability to leverage its currency as a tool of global influence. This trend also reduces the effectiveness of US sanctions and diminishes the demand for US Treasury bonds, potentially raising domestic borrowing costs for the US. This development also supports financial stability in the participating countries, particularly those in the global South. These nations benefit from reduced exposure to the volatility of the US dollar, improved trade efficiency, and greater access to alternative financing options, which reflect a broader movement towards a more diversified global financial system. Historically, the US dollar's rise as the world's primary reserve currency can be traced back to a series of geopolitical, economic, and institutional factors. In the early 20th century, the US gained economic power as it became a key creditor nation, especially after World War I. The creation of the Federal Reserve in 1913 and the Bretton Woods Agreement in 1944 further solidified the dollar's position at the center of global finance. The dollar's dominance was reinforced after World War II, with the U.S. economy growing rapidly and institutions like the IMF and World Bank anchoring global financial systems around the dollar. Despite the shift to floating exchange rates in the 1970s, the dollar remained the dominant global currency, thanks to the strength of the U.S. economy and the depth of its financial markets. However, in recent years, the U.S. dollar's dominance has begun to face serious challenges, driven by the rise of alternative currencies and the increasing trend of dedollarization. Dollarization refers to the process by which countries, particularly those in the global South, reduce their dependence on the U.S. dollar in international trade and finance. This trend is largely driven by the desire for economic sovereignty, reduced vulnerability to U.S. sanctions, and the need to diversify financial reserves. In the 1990s, the U.S. dollar accounted for over 70% of global foreign exchange reserves, but as of late 2023, this share had dropped to approximately 59%. Countries are increasingly turning to other currencies, such as the euro or yuan, to mitigate the risks associated with dollar volatility and US-led economic sanctions. Nations like Russia, Iran, and Venezuela, for example, have sought to reduce their exposure to US sanctions by bypassing the US dollar in favor of local currencies or other alternatives. For instance, Russia has shifted more than 90% of its trade with China to local currencies, particularly the yuan. Financial sovereignty is another driving force behind dollarization. Many countries want to regain control over their economic policies, which are often dictated by external factors tied to the US dollar's fluctuations. By adopting local currencies or trading in alternative currencies, these nations reduce the impact of US monetary policies on their economies. Economic diversification also plays a crucial role in the shift away from the dollar. For example, Saudi Arabia's Vision 2030 initiative seeks to reduce the kingdom's reliance on oil revenues, and part of this diversification strategy includes engaging in RMB-denominated trade. Similarly, the UAE is using its swap agreement with China to facilitate oil transactions in yuan, further reducing its dependence on the dollar. China, in particular, has been a driving force in the dedollarization movement, with its Belt and Road Initiative and growing influence in global finance. The country has established currency swap agreements with over 40 nations, including Russia, Saudi Arabia, Argentina, and several African nations. This has promoted the use of the yuan in international trade, further solidifying China's economic influence. The trend towards de-dollarization and the rise of alternative currencies is particularly evident in the global South, where emerging economies are finding greater economic empowerment through currency diversification. This shift not only reduces their reliance on US-led financial systems but also strengthens regional trade and cooperation. Moreover, it offers these countries more resilience against global economic shocks, as evidenced by the volatility witnessed during the COVID-19 pandemic and the 2008 financial crisis. Countries in the global South are also aligning more closely with emerging economic powers like China, whose efforts to promote the yuan and reduce the dollar's influence provide these nations with an opportunity to assert their growing role in the global economy. This geopolitical shift could lead to a more balanced, multipolar financial system, which challenges the US's unilateral control over global markets. As the US dollar's global dominance weakens, the US has increasingly reacted with defensive measures. US President-elect Donald Trump has warned BRICS nations about the potential consequences of moving away from the dollar, suggesting that he might impose tariffs on countries that adopt alternative currencies. However, such measures highlight the growing difficulty the US faces in maintaining the dollar's hegemony, particularly in light of the rising global momentum towards dollarization. This global trend marks a significant challenge to the US's ability to influence world markets through the dollar. The dollar's waning influence, combined with the rise of alternative currencies and financial systems, is reshaping the future of international finance.